On December 31st, 2025, 7 corporations, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, collectively hold a market valuation of $14.2 trillion. This figure represents 32% of the total S&P 500 index. However, a significant issue arises. These 7 entities trade at an average price-to-earnings ratio of 42, starkly contrasting with the historical average of 22 for market leaders. For this elevated valuation to be sustainable, these companies would need to achieve an annual earnings growth rate of 25% for the subsequent 5 years. Yet these entities are maturing, and their growth trajectories are diminishing. Apple's iPhone sales have stagnated, Microsoft's cloud division is experiencing decelerating expansion, and Nvidia faces headwinds due to export restrictions imposed on China. Should growth falter and multiples contract from 42 to 28, a level still exceeding the historical norm, these 7 stocks could see their combined value plummet by $4.8 trillion. When 32% of the market's value disintegrates, the remaining 68% is inevitably pulled downward, potentially leading to an overall market decline of 45 to 50%. This scenario is not a matter of speculative conjecture regarding a distant improbability. Rather, it is a mathematical certainty unfolding in real time. This represents the most substantial concentration of wealth in the fewest companies in market history. Trading at valuations that can only be justified by growth rates, these businesses are demonstrably no longer achieving. Consequently, when reality confronts inflated expectations, the ensuing collision is poised to obliterate more wealth than any market downturn since 2008. The underlying mechanism is straightforward, the timeline is discernible, and the repercussions could impact tens of millions of individuals. Retirement accounts, pension funds, and college savings plans heavily invested in these 7 companies will witness decades of accumulated wealth evaporate within months. The trap has already been sprung. Every passive index fund, every S&P 500 tracking 41K, and every pension fund automatically allocates 32% of its holdings to these 7 giants. This is not a result of astute portfolio management or a concluded assessment of their intrinsic value, totaling $14.2 trillion. Instead, it stems from the sheer size of these stocks, compelling passive funds to purchase them based on market capitalization rather than fundamental worth. As their size increases, so does the influx of capital, which in turn further inflates their size, a self-perpetuating cycle that functions impeccably during upward market trends. However, during a downturn, this same mechanism transforms into a catastrophic downward spiral, and that descent has already commenced. This analysis does not constitute financial counsel. It is an examination of concentrated risk, valuation compression, and the inescapable mathematical probability that when the 7 largest companies in market history cease to exhibit the growth rates necessary to support their valuations, trillions in wealth will vanish, triggering a violent repricing of the entire market. I will elucidate precisely why these valuations are untenable, how this collapse will propagate through the financial system, who stands to profit from this decimation, and what the future holds. To comprehend why this situation diverges from every prior market correction you have experienced, one must grasp the unprecedented scale of concentration we are currently witnessing. Market concentration has been meticulously tracked for over a century, with records extending back to 1926. Never before, not in 1929 when railroads and steel trusts dominated the market, nor in 1972 during the Nifty 50 bubble, nor even in 1999 at the zenith of the dot-com frenzy, has such a colossal percentage of total market value been consolidated within such a diminutive number of entities. As of December 31st, 2025, the S&P 500 index boasts a total market capitalization of $44.3 trillion. Out of this sum, 7 companies account for $14.2 trillion, signifying 32% of the entire index within just 7 names. To provide context, the bottom 250 companies in the S&P 500, comprising half of the index, possess a combined market capitalization of merely $3.1 trillion. The top 7 companies are worth 4.6 times more than the aggregate value of the bottom half of the index. 7 companies hold greater value than 250 companies. This is not a functioning market. It is a de facto monopoly. This concentration has escalated exponentially in recent years. In 2013, a mere 12 years ago, the top 7 companies constituted 13.4% of the S&P 500. By 2018, this figure had risen to 18.7%. In 2020, amidst the COVID-induced boom, they accounted for 23.4%. In 2023, their share grew to 28.9%. Now, at the conclusion of 2025, they command 32.1%. This concentration is not stabilizing, it is accelerating. Each quarter, these 7 corporations claim an increasingly larger portion of the total market value, and with each passing quarter, the associated risk becomes more acute. This is the crucial point. When you invest in an S&P 500 index fund, you believe you're diversified across 500 distinct entities, but this is a misperception. Instead, you are effectively placing a leveraged wager that 7 specific companies will continue to grow at a pace robust enough to justify valuations that have historically proven unsustainable. Should these 7 giants falter, your ostensibly diversified portfolio will experience a catastrophic decline. The remaining 493 companies are insufficient to provide a buffer, as they collectively represent only 68% of the market's value. The dominance of the 7 behemoths is absolute. The very mechanism that fueled this concentration now guarantees an equally dramatic reversal. This mechanism is passive investing. Currently, $11 trillion is invested in passive index funds and exchange-traded funds that mirror the S&P 500. When capital flows into these funds, it is allocated based on market capitalization weighting. For instance, if Apple comprises 7.9% of the index, then 7.9% of every dollar entering an S&P 500 fund is automatically used to purchase Apple stock, irrespective of its current price, whether it is overvalued or undervalued, or whether Apple's business is expanding or contracting. This creates a powerful feedback loop. Apple's stock price appreciates because passive capital consistently buys it. A higher stock price elevates Apple's market capitalization. A larger market capitalization increases Apple's weighting within the index. A greater index weighting then dictates that an even larger proportion of subsequent inflows will be directed towards Apple. This cycle intensifies, driving Apple's stock higher not due to fundamental business improvements, but solely because its stock price is rising. It is a self-reinforcing, circular dynamic that functions flawlessly until an external factor disrupts the loop. That disruption is imminent because the underlying business fundamentals can no longer sustain the prevailing valuations. Let us now examine each company individually to demonstrate why their stocks are mathematically overvalued and why a valuation compression is unavoidable. Apple, with a market capitalization of $3.5 trillion, currently trades at a price-to-earnings ratio of 33. This signifies that investors are paying $33 for every dollar of annual profit Apple generates. Historically, mature technology firms have traded within a price-to-earnings range of 18 to 22. Apple's current valuation sits 50% above the upper limit of this historical range. The rationale behind this premium is the market's expectation of continued rapid growth. However, Apple is not experiencing rapid growth. Its expansion is, at best, marginal. iPhone sales, which constitute 52% of Apple's total revenue, peaked in 2021 with sales of 240 million units. In 2025, Apple sold 243 million iPhones, a slight decline rather than a plateau. The iPhone, Apple's primary revenue generator and the product that propelled it to become the world's most valuable company, has reached its apex and is now experiencing a contraction. There is no discernible evidence to suggest a reversal of this trend. The global smartphone market is saturated. Virtually everyone who desires a smartphone already possesses one. Furthermore, device replacement cycles are lengthening, extending from 2 years to 3 or even 4 years, driven by increased phone durability and the incremental nature of technological innovations. Apple's services division, encompassing the App Store, Apple Music, iCloud, and AppleCare, was anticipated to serve as the growth engine, compensating for decelerating iPhone sales. In 2023, services revenue grew by 18%. This growth decelerated to 12% in 2024, with projections for 2025 indicating a further slowdown to 8%. The deceleration is unequivocally evident and is worsening. Service revenue is approaching saturation. as it is intrinsically linked to the installed base of devices, and this installed base is no longer expanding. Apple's operations in China, which accounted for 18% of its total revenue in 2022, have been in decline. Data from December 2025 indicates a 4% year-over-year decrease in Chinese revenue. Chinese consumers are increasingly opting for domestic brands such as Huawei, which has re-emerged with advanced chip technology despite United States sanctions. Apple is consequently losing market share in the world's largest smartphone market, with no apparent strategy to counteract this trend. Therefore, Apple's annual revenue growth is estimated to be between 3 and 5%. Earnings growth, bolstered by share buybacks that reduce outstanding shares, is projected to be between 5 and 7%. Despite this modest growth, the stock trades at 33 times earnings. For a company experiencing only 5% growth, a justifiable price-to-earnings ratio would typically be in the range of 18 to 20. If Apple's price-to-earnings ratio were to compress to 18, its stock price would fall from its current level of $245 per share to $134, representing a 45% decline. Apple's market capitalization would then shrink from $3.5 trillion to $1.9 trillion, signifying an evaporation of $1.6 trillion in wealth from this single entity. However, the impact extends further. Apple represents 7.9% of the S&P 500 by index weight. A 45% decline in Apple's stock would directly reduce the S&P 500 by 3.6%. Crucially, the repercussions do not end there. When the largest, most ostensibly secure, and most profitable company within the index experiences a significant downturn, it triggers widespread panic. Investors do not rationally assess that while Apple may be declining, other assets remain unaffected. Instead, they perceive that if Apple can collapse, nothing is truly safe, leading to a contagion of panic selling. Microsoft, with a market capitalization of $3.3 trillion, currently trades at a price-to-earnings ratio of 38. Microsoft has been prominently lauded as an artificial intelligence leader. Wall Street widely believes that Microsoft's strategic alliance with OpenAI, the creator of ChatGPT, coupled with its integration of AI technologies across its Office 365 suite, Azure Cloud Services, and Windows operating system, positions the company to dominate the burgeoning AI revolution. The stock has surged considerably based on this prevailing narrative. However, the underlying financial figures do not substantiate this optimistic outlook. Azure, Microsoft's cloud computing platform and its primary growth engine, experienced annual growth rates of 50% between 2020 and 2022. In 2023, Azure's growth rate decelerated to 28%, and in 2024, it further declined to 16%. This represents a rapid and sustained deceleration. Given that Azure accounts for approximately 35% of Microsoft's total revenue, the question arises, why does the entire company trade at 38 times earnings if its core growth driver is expanding at only 16% and decelerating? The revenue generated from AI initiatives by Microsoft is reportedly being significantly inflated by analysts' projections. Microsoft does not disclose specific AI-related revenue figures, leading analysts to derive their estimates from management commentary. However, a careful analysis of Azure's growth rates when juxtaposed with overall revenue growth suggests that the AI contribution is considerably less substantial than the current hype implies. Microsoft's total revenue grew by 15% in 2024. If AI were truly the transformative force it is portrayed to be, revenue growth should be accelerating, not merely maintaining a steady mid-teens pace. Historically, enterprise software companies exhibiting revenue growth rates between 12 and 18% typically trade at price-to-earnings ratios ranging from 24 to 28. If Microsoft's price-to-earnings ratio were to contract to 26, a valuation still considered generous, the stock price would plummet from $465 to $319, a decline of 31%. This would reduce Microsoft's market capitalization from $3.3 trillion to $2.3 trillion, representing a loss of $1 trillion. Nvidia, with a market capitalization of $2.9 trillion, trades at a price-to-earnings ratio of 58. This makes it the most overvalued stock among the Magnificent Seven by a considerable margin. Nvidia has been a primary beneficiary of the artificial intelligence infrastructure boom, supplying the graphics processing units, GPUs, essential for powering data centers engaged in training large language models. Its revenue has experienced an explosive trajectory, rising from $27 billion in 2022 to $61 billion in 2023, and further to $113 billion in 2024. This represents extraordinary growth. However, this growth is unsustainable for three critical reasons. Firstly, the build-out of AI infrastructure is a finite undertaking, not an infinite one. There is a discernible limit to the number of data centers required for AI model training. Major tech corporations such as Meta, Google, Microsoft, and Amazon are collectively investing approximately $200 billion annually in AI infrastructure. While this figure appears substantial, it primarily represents a one-time capital expenditure, not a recurring annual commitment. Once data centers are constructed and equipped with GPUs, they do not necessitate annual reconstruction. Consequently, capital expenditure will inevitably normalize, and as it does, NVIDIA's revenue growth is poised to collapse. Secondly, United States export restrictions have permanently removed 25% of NVIDIA's potential market. The US government has prohibited the export of advanced GPUs to China, and these restrictions are expected to tighten further, not loosen. NVIDIA is thus precluded from selling its highest margin products to the world's second-largest economy, resulting in a permanent loss of potential annual revenue estimated between $30 and $40 billion. Thirdly, competitive pressures are intensifying at an alarming rate. AMD is steadily increasing its market share in data center GPUs. Google has developed tensor processing units, TPUs, custom-designed chips for AI training that reduce reliance on NVIDIA. Amazon has introduced its own Trainium and Inferentia chips for similar purposes, and Microsoft is actively designing its own custom silicon. Every major cloud provider is actively seeking to diminish its dependence on NVIDIA, driven by NVIDIA's current monopoly pricing power. This monopoly is on the verge of dissolution. For a semiconductor company, even one enjoying temporary market dominance, a price-to-earnings ratio of 58 is extraordinarily high. Intel, at its peak in 2000, traded at a price-to-earnings ratio of 35, and that was during the dot-com bubble. NVIDIA's current valuation of 58 prices in perpetual exponential growth, which is an unrealistic expectation. A more normalized price-to-earnings ratio for a semiconductor company typically falls between 20 and 25. If NVIDIA's price-to-earnings ratio were to compress to 22, its stock price would plunge from $790 to $298, a staggering 62% decline. This would reduce its market capitalization from $2.9 trillion to $1.1 trillion, erasing $1.8 trillion in value. Amazon, with a market capitalization of $2.2 trillion, trades at a price-to-earnings ratio of 41. Amazon operates two distinct business segments. Its retail division generates 80% of its revenue, but operates on thin profit margins of 3 to 5%. Amazon Web Services, AWS, its cloud computing division, accounts for 20% of revenue, but contributes 60% of its operating profit. Investors primarily value Amazon based on AWS's growth trajectory. However, AWS growth is decelerating for reasons similar to those affecting Azure. The cloud computing market is maturing. AWS experienced growth rates of 38% in 2021, 29% in 2022, 19% in 2023, and 13% in 2024. Each year, growth diminishes, with no apparent catalyst to reverse this trend. Cloud adoption is already advanced. Most companies that would migrate to the cloud have already done so. The remaining migration primarily involves legacy systems, rather than explosive new growth. Concurrently, Amazon's retail business faces significant structural challenges. Labor costs are escalating as Amazon struggles to recruit and retain warehouse workers in a competitive labor market, offering wages between $15 and $17 per hour. Fulfillment center turnover rates exceed 150% annually, meaning Amazon must replace its entire warehouse workforce every 8 months. Training expenses are substantial, shipping costs remain elevated, and competition from Temu, Shein, and other ultra-low-cost Chinese retailers is eroding Amazon's e-commerce dominance. A company experiencing overall earnings growth of only 12% cannot logically justify a price-to-earnings ratio of 41. If Amazon's price-to-earnings ratio were to compress to 26, its stock would fall from $229 to $145, a decrease of 37%. This would reduce its market capitalization from $2.2 trillion to $1.4 trillion, a loss of $800 billion. Alphabet, with a market capitalization of $2.1 trillion, trades at a price-to-earnings ratio of 28. While Alphabet appears to be the most reasonably valued among the Magnificent Seven, this designation does not equate to safety. Alphabet is confronted with an existential threat that investors are systematically underestimating. Alphabet derives 80% of its total revenue from advertising. Of this advertising revenue, 58% is generated specifically from Google search ads. This core business model, where users conduct searches, click on ads, and advertisers pay, is under direct assault from artificial intelligence. When users pose queries to platforms like ChatGPT, Claude, or Perplexity, they receive direct answers without needing to navigate to external websites, and consequently, they do not see advertisements. The AI provides the answer directly within its interface. Every query answered by AI represents a missed opportunity for Google to display ads, thereby directly cannibalizing Google's primary revenue stream. Alphabet is attempting to counter this threat by integrating AI into its search functionality through Gemini and AI overviews. However, this strategy creates a paradox. If Google presents AI-generated answers directly within search results, users will have less incentive to click through to individual websites. Fewer clicks translate to fewer ad impressions, and fewer ad impressions result in diminished revenue. Google is essentially compelled to undermine its own business model in order to compete with AI chatbots. Either way, revenue generation suffers. Furthermore, Alphabet's Other Bets division, which encompasses ventures such as Waymo, self-driving cars, Verily Life Sciences, and various ambitious moonshot projects, has incurred cumulative losses exceeding $33 billion since its inception, with minimal corresponding revenue. These are essentially scientific experiments demanding billions in annual investment with no clear path toward profitability. If concerns regarding the disruption of its search business lead to Alphabet's price-to-earnings ratio compressing to 20, its stock would decline from $198 to $141, a 29% decrease. This would reduce its market capitalization from $2.1 trillion to $1.5 trillion, wiping out $600 billion. Meta, with a market capitalization of $1.4 trillion, trades at a price-to-earnings ratio of 27. On a pure price-to-earnings basis, Meta is indeed the most reasonably valued among the Magnificent Seven. However, a reasonable valuation does not inherently eliminate risk. Meta faces significant challenges that could precipitate a contraction in its valuation multiples. User engagement on Facebook, particularly among individuals under the age of 30, is in decline. Younger demographics exhibit a preference for platforms such as TikTok, Instagram Reels, and Snapchat. Meta has responded by aggressively promoting Reels, and its usage has indeed surged dramatically. However, the critical issue is that Reels generate 60% less revenue per user compared to traditional content formats on Facebook and Instagram feeds. Consequently, even as user engagement shifts towards Reels, the revenue generated per user decreases. Meta is effectively increasing engagement while simultaneously diminishing its monetization capabilities. More concerning is the performance of Reality Labs, Meta's metaverse division. Reality Labs has incurred losses of $4 billion per quarter, or $16 billion annually, for the past 3 consecutive years. Cumulative losses have now surpassed $55 billion. Revenue from Reality Labs approximates $600 million quarterly, translating to $2.4 billion in annual revenue against $16 billion in annual losses. Mark Zuckerberg is expending $16 billion annually on a venture that generates merely $2.4 billion in revenue, representing a monumental destruction of shareholder value. If investors lose patience with the substantial metaverse expenditures and concerns regarding declining monetization intensify, Meta's price-to-earnings ratio could compress to 18, a multiple consistent with that of a mature social media platform. At a price-to-earnings ratio of 18, the stock would fall from $686 to $457, a 33% decline. This would reduce its market capitalization from $1.4 trillion to $933 billion, representing a loss of $467 billion. Tesla, with a market capitalization of $1.1 trillion, trades at a price-to-earnings ratio of 73. This represents the most egregious overvaluation, not only within the Magnificent Seven, but across the entirety of the S&P 500. Tesla's valuation of 73 times earnings is applied to a car manufacturer experiencing only 3% annual growth. To reiterate, 73 times earnings for a mere 3% growth. Every other automobile manufacturer globally trades at price-to-earnings ratios ranging from 5 to 8. Ford, for instance, trades at 6 times earnings, General Motors at 5 times earnings, and Toyota at 9 times earnings. These are established and profitable car companies. Tesla commands a 73 times earnings multiple because Wall Street does not perceive it solely as an automobile manufacturer. Rather, it is valued as a technology company poised to achieve full self-driving capabilities, deploy a robotaxi fleet, and eventually manufacture humanoid robots. However, the promise of full self-driving has consistently been forecast as 2 years away for the past decade. Elon Musk in 2016 predicted that Teslas would be capable of driving themselves coast to coast by 2017. It is now 2025, and full self-driving still requires constant driver supervision and intervention. It remains at Level 2 autonomy, not the anticipated Level 4 or 5. Regulatory approval for unsupervised self-driving appears improbable, given the company's safety record and associated liability concerns. The implementation of robotaxis faces considerable legal, insurance, and regulatory hurdles. Humanoid robots, for all intents and purposes, remain in the realm of science fiction rather than near-term revenue generators. Meanwhile, Tesla's core automotive business is experiencing a deterioration. Sales growth has drastically decelerated. In 2021, Tesla delivered 936,000 vehicles, an 87% increase year over year. In 2022, deliveries grew by 40%. By 2023, this growth had fallen to 19%, and in 2024, it further declined to 8%. Projections for 2025 indicate a growth rate of only 3%. The trajectory is unmistakable. Growth is rapidly diminishing. Competition has intensified significantly. BYD of China has emerged as the world's largest electric vehicle manufacturer and is expanding its global presence. Concurrently, Hyundai and Kia have introduced compelling electric vehicles priced lower than Tesla's offerings, while traditional manufacturers like General Motors, Ford, Volkswagen, and Mercedes are finally scaling their EV production. Tesla's initial first-mover advantage has evaporated. In response, Tesla has resorted to aggressive price reductions to maintain sales volume, but these price cuts invariably erode profit margins. Automotive gross margins have fallen from 32% in 2021 to 18% in 2024. Operating margins have similarly decreased from 14.6% to 8.2%. Tesla is now generating less profit per vehicle while experiencing sluggish growth. This represents a classic death spiral for an automotive company. If Tesla were to be valued based on its actual operations as a car manufacturer, it should trade at a price-to-earnings ratio of 12 to 15, and even that would be considered generous given its minimal 3% growth rate. At a price-to-earnings ratio of 12, Tesla's stock would plummet from $420 to $69, an 84% collapse. Its market capitalization would shrink from $1.1 trillion to $180 billion, erasing $920 billion. Now let us aggregate the potential wealth destruction. Apple faces a potential loss of $1.6 trillion. Microsoft's valuation plummets by $1 trillion. Nvidia experiences a staggering loss of $1.8 trillion. Amazon sees its market capitalization shrink by $800 billion. Alphabet's value diminishes by $600 billion. Meta endures a reduction of $467 billion. Tesla's worth declines by $920 billion. The cumulative value erased solely from price-to-earnings multiple contraction amounts to $7.2 trillion. This estimation assumes a compression to price-to-earnings ratios between 18 and 26, which remain elevated compared to historical averages. Should these multiples contract to the traditional historical range of 15 to 20, the value destruction would surpass $9 trillion. However, this decline does not occur in isolation. A cascading effect, amplified by passive investment flows, exacerbates the damage across the entire financial landscape. This is precisely where systemic risk becomes alarmingly apparent. The cascade unfolds as follows. The prominent Magnificent Seven companies begin to falter as their earnings disappoint, and the deceleration in their growth becomes undeniable. Let us postulate an initial 15% decline across these 7 stocks in the first quarter of 2026 as market realities converge with prior expectations. This 15% drop in equities, representing 32% of the index's total market value, directly reduces the S&P 500's performance by 4.8%. Yet this represents merely the mechanical impact. The psychological repercussions are considerably more profound. Investors holding S&P 500 index funds witness their account values shrinking, prompting them to initiate redemptions of their fund shares. When investors redeem their holdings from an index fund, the fund is compelled to liquidate its assets to generate the necessary cash to disburse to those exiting investors. Due to market capitalization weighting, 32% of every dollar redeemed necessitates the fund selling shares of the Magnificent Seven companies. This action initiates a wave of forced selling, entirely detached from the fundamental performance of these businesses. It is a purely mechanical process. This selling pressure drives stock prices lower. Diminished stock prices lead to reduced market capitalizations. Lower market capitalizations, in turn, result in decreased index weights for these companies. However, given the continuous daily redemptions and the sustained dominant market presence of the Magnificent Seven, they continue to bear the brunt of this selling pressure. This engenders a destructive feedback loop, where selling begets lower prices, which instigates further selling, leading to even more depressed prices. Concurrently, market volatility surges. The VIX, an indicator of market volatility that remained subdued below 15 for the majority of 2022, spikes above 30 as the market descends. Increasing volatility triggers automatic deleveraging by risk parity funds, which systematically reduce their equity exposure. When volatility escalates, these funds disregard fundamental analysis. They adhere to a predefined formula. High volatility necessitates a reduction in equity holdings, prompting them to sell. Market makers who have sold call options on these stocks are compelled to hedge their positions by selling the underlying equities. As prices decline, this delta hedging creates additional mechanical selling pressure, accelerating the downward trajectory. Momentum-based investment strategies, which had been long on the Magnificent Seven due to their superior performance, are forced to sell when these stocks breach critical technical support levels. Momentum strategies are trend-following mechanisms. When a trend reverses, they divest regardless of a stock's valuation. All these mechanical selling programs become active simultaneously. Passive outflows, risk parity deleveraging, options hedging, and momentum capitulation. The selling activity feeds upon itself. This is not a market correction where discerning investors rationally assess fair value and seize buying opportunities. Instead, it is a cascade where mandated selling overwhelms any fundamental buying interest. Historical precedent unequivocally supports this pattern. In February 2018, a VIX surge precipitated a 12% market decline over 2 weeks as risk parity funds unwound their leverage. In March 2020, the COVID-19 pandemic triggered cascading liquidations, resulting in a 34% market contraction within a single month. However, those downturns occurred when passive investment flows were considerably smaller. Today, passive flows are 9 times larger than they were in 2008. The concentration of capital is more extreme. Consequently, the ensuing cascade is poised to be significantly more severe. We estimate that when the Magnificent Seven stocks experience an initial 30% decline, the forced selling stemming from passive flows, risk parity strategies, options hedging, and momentum trades will drive them down an additional 25%, resulting in a cumulative 55% drop. This would lead to a combined market capitalization destruction of $7.8 trillion. The S&P 500, with its 32% weighting in these 7 companies, would directly suffer a 17.6% decline attributable to their collapse. However, the remaining 68% of the market would also experience downturns as the same forced selling pressures impact those equities. Economic anxieties would intensify amidst the disintegration of mega-cap technology stocks and a tightening of credit conditions. The total decline for the S&P 500 from its December 2025 peak would range between 42 and 48%. Now allow me to illustrate a historical parallel that demonstrably proves this precise pattern has occurred previously and will inevitably repeat. The Nifty 50 bubble of 1972 to 1974 bears not just a resemblance to today's market conditions, it is an exact replication in every aspect, save for the nomenclature of the companies involved. In the late 1960s and early 1970s, institutional investors overwhelmingly concentrated their portfolios within 50 large-cap stocks, collectively known as the Nifty 50. These were regarded as one-decision stocks, meaning investors bought them with the intention of never selling, as they were perceived as the preeminent companies in America, possessing exceptional growth trajectories and unparalleled management teams. This roster included iconic names such as Coca-Cola, IBM, Xerox, Polaroid, McDonald's, Walt Disney, Procter & Gamble, Avon, Eastman Kodak, among others. These corporations held sway over the American economy and were widely believed to be enduringly superior investments that justified any price paid for them. By 1972, these 50 stocks constituted 38% of the total market capitalization of all publicly traded U.S. equities, a level of concentration even greater than today's 32% held by the 7 dominant companies. Furthermore, these Nifty 50 stocks traded at an average price-to-earnings ratio of 41.9, while the broader market commanded a mere 18.9 multiple. The Nifty 50 companies commanded a premium of 2.2 times the market's valuation multiple. Investors rationalized these stratospheric valuations by asserting that these corporations possessed permanently superior growth characteristics and thus merited premium multiples. The most extreme illustrations of this phenomenon were Polaroid, which traded at a price-to-earnings ratio of 90 in 1972, Xerox at 48 times earnings, McDonald's at 86 times earnings, IBM at 35 times earnings, and Avon at 65 times earnings. The prevailing argument was remarkably congruent with the contemporary justifications for the valuations of the Magnificent Seven. These were the finest companies, boasting cutting-edge technology and the most promising growth prospects. They were deemed so exceptional that conventional valuation metrics were rendered irrelevant. The market was exhorted to assign whatever multiple it deemed fitting, predicated on the unwavering expectation of perpetual growth. Investors were encouraged to pay any price, confident in the long-term rewards. Then, the music stopped. In 1973, the OPEC oil embargo triggered a quadrupling of oil prices. Inflation surged to 11%. The Federal Reserve, which had maintained low interest rates throughout the late 1960s, embarked on an aggressive campaign to combat inflation by raising rates significantly. The federal funds rate escalated from 5% to 13%. The economy plunged into a severe recession. Corporate earnings growth stagnated, and the Nifty 50 experienced a precipitous collapse. From December 1972 to September 1974, the Nifty 50 stocks collectively plummeted by an average of 64%. However, the most exorbitantly valued stocks were utterly annihilated. Polaroid shares plunged 91%, Avon 86%, Xerox 71%, McDonald's 68%, and even the most fundamentally robust companies suffered dramatic declines. Coca-Cola fell 64%, Walt Disney 77%, and IBM 48%. The price-to-earnings multiples contracted violently. Polaroid's multiple contracted from 90 to a mere 5. Avon's fell from 65 to 8. Xerox's decreased from 48 to 9. These valuations proved unsustainable once growth faltered and the economic environment deteriorated. Investors who had paid 50 to 90 times earnings discovered that when earnings growth ceases, the price-to-earnings ratio collapses into single digits. Consequently, the stock price must plummet 80 to 90% to reach a defensible valuation. The broader market declined 48% from its peak to its trough during the 1973 and 1974 bear market. However, the Nifty 50 experienced a 64% decline, underscoring that the most concentrated and overvalued stocks suffered more acutely than the market average. The inherent concentration fostered fragility, not security. And here lies the critical lesson that investors today adamantly refuse to internalize. These were indeed exemplary companies. Coca-Cola did not go bankrupt. IBM did not vanish. Disney not only survived, but prospered. McDonald's continued its growth trajectory. However, their stock prices collapsed because their valuations were patently absurd. When an investor pays 90 times earnings for a stock, they are implicitly assuming extraordinary growth for decades to come. When such anticipated growth fails to materialize, the valuation is mandated to adjust. This adjustment is invariably brutal. Shareholders suffered annihilation, even as the underlying companies endured. Coca-Cola eventually recovered and surpassed its previous highs, but this took 15 arduous years. Investors who purchased Coca-Cola shares at the 1972 zenith did not achieve break-even until 1987, representing 15 years of zero return. And this is an account for one of the world's most consistently high-quality companies. The lower-tier Nifty 50 constituents never regained their former standing. This mirrors the predicament confronting the Magnificent Seven today. Apple, Microsoft, and Alphabet are highly likely to persist as viable and profitable entities. However, their stock prices are currently priced for growth that is demonstrably not materializing. As valuations contract, shareholders face potential losses ranging from 40 to 70%, irrespective of the company's continued survival. Tesla and Nvidia, currently the most overvalued among the group, may not endure as independent corporate entities. They face the prospect of acquisition or even bankruptcy should conditions deteriorate significantly. Now, allow me to delineate the precise timeline of how this scenario is likely to unfold over the ensuing 12 months, drawing upon historical crash patterns and prevailing market dynamics. Quarter 1 of 2026, encompassing January through March. This period marks the undeniable crystallization of growth deceleration. The earnings season for fourth quarter 25 results, released in mid-January, will serve as a pivotal catalyst. Apple will report a 3% year-over-year decline in iPhone sales. Its services revenue growth will decelerate to 6%. The guidance for fiscal year 26 will be issued cautiously, with management citing macroeconomic uncertainties, escalating competition in China, and unfavorable currency headwinds. The stock will subsequently fall 8% in after-hours trading. 2 weeks later, Microsoft will announce that Azure revenue has increased by 14%, continuing the deceleration from 16% in the preceding quarter. Revenue generated from artificial intelligence, while growing, will fall short of Wall Street's projections. Analysts had modeled $8 billion in AI revenue. However, the actual reported figure will be $5.2 billion. The stock will drop 7%. Nvidia will report extraordinary revenue growth of 38%. While seemingly impressive, this figure represents a significant deceleration from 200% growth in the prior year and 110% in the year preceding that. The downward trend in growth is unmistakably clear. Management will issue a warning indicating that the data center build-out is normalizing and competitive pressures are intensifying. Despite exceeding earnings estimates, the stock will fall 12% due to disappointing forward guidance. Amazon will report AWS growth of 12%, marking the slowest quarterly expansion in AWS history. Retail operating margins will contract to 2.8%, a decline from 8%, attributed to escalating labor and shipping expenses. The stock will fall 9%. Tesla will report a 2% increase in deliveries. Automotive gross margins will decline to 16.4%. Production of the Cybertruck will continue to fall short of expectations. The stock will plummet 15%. By the close of January, the Magnificent Seven stocks will have collectively declined by an average of 9%. The S&P 500 will be down 4%. Volatility will rise from 13 to 19. Investors will exhibit nervousness, but the financial media will frame these movements as a healthy correction and a prime buying opportunity. CNBC will feature segments with titles such as "Why the Magnificent Seven Are Still Magnificent." Analysts will publish reports asserting that the growth narrative remains intact. They will be mistaken. February and March will witness continued market weakness. Each subsequent earnings call will confirm a more pronounced growth slowdown than anticipated. Analysts will commence downward revisions of earnings estimates. The initial downgrades will originate from smaller, independent research firms unburdened by banking relationships with these corporations, thus affording them the liberty to convey candid assessments. Goldman Sachs, Morgan Stanley, and J.P. Morgan will maintain their stubbornly bullish stances, constrained by the imperative not to alienate these companies, which are also significant investment banking clients. By the conclusion of the first quarter of 2026, The Magnificent Seven stocks will have depreciated between 14 and 22% from their December 2025 peaks. Apple will be down 16%, Microsoft down 14%, Nvidia down 22%, reflecting its heightened overvaluation. Amazon will be down 17%, Alphabet down 11%, Meta down 15%, and Tesla down 28%. The S&P 500 will have declined 8%. Volatility will have escalated to 25. The prevailing market narrative will shift from a healthy correction to a more pressing inquiry. Is this something more serious? Quarter 2 of 2026, from April through June. This period will witness the market correction accelerating into a full-blown crash. April's earnings reports for the first quarter of 2026 will unequivocally confirm that the underlying problems are exacerbating, not ameliorating. Apple will report a 5% year-over-year decline in iPhone sales. Revenue from China will fall 12% as Chinese consumers increasingly boycott American brands in favor of domestic manufacturers like Huawei. Services growth will decelerate to a mere 5%, half the rate observed 2 years prior. The stock will drop an additional 12%, bringing Apple's total decline from its peak to 28%. Microsoft will report Azure growth of 11%. While AI revenue will increase, the company's overall revenue growth will be a modest 12%. If AI truly represents such a revolutionary paradigm shift, why is overall revenue growth not accelerating? Investors will begin to question the AI narrative, and the stock will fall 11%, now 25% below its peak. Nvidia will announce that 3 major cloud providers have declared their intention to reduce their purchases of Nvidia GPUs, opting instead for custom-designed chips. Revenue growth will stand at 22%, a positive figure, but representing a deceleration from 38% in the preceding quarter. The market will begin to price in the imminent end of the artificial intelligence infrastructure boom. The stock will crash 18% in a single trading day, now down 40% from its peak. The capitulation will commence. Wall Street's major investment banks will find it impossible to sustain their bullish posture. Goldman Sachs will downgrade Apple, Microsoft, and Nvidia to neutral, accompanied by substantially reduced price targets. Morgan Stanley will follow suit. JP Morgan will also adopt a similar stance. The narrative will transform from buy the dip to await clarity. However, clarity rarely emerges during market crashes. Investors will not wait. They will panic. Redemptions from S&P 500 index funds will surge. A combined $180 billion will flow out of these funds in April and May. Index funds will be compelled to liquidate their holdings to meet these redemption requests. Due to market capitalization weighting, 32% of these sales will impact the Magnificent Seven stocks, equating to $58 billion in forced selling directed at these 7 companies. This passive selling will initiate a cascade. Prices will decline. Falling prices will trigger stop-loss orders. Stop-loss orders will precipitate further selling. Algorithmic trading systems will detect the market breakdown and initiate short positions. Momentum strategies will reverse from long to short positions. Risk parity funds will mechanically reduce their equity exposure as volatility breaches the 35 level. By the end of June, the Magnificent Seven stocks will be in a state of freefall. Apple will be down 38%, Microsoft down 36%, Nvidia down 53%, Amazon down 41%, Alphabet down 34%, Meta down 39%, and Tesla down 58%. The S&P 500 will have fallen 26% from its peak, and the Nasdaq will be down 35%. This officially constitutes a market crash. Quarter 3 of 2026, from July through September. The cascade will reach its completion. Selling pressure will be relentless. Margin calls will be triggered for leveraged investors. Retail investors who had consistently purchased during every perceived dip in the first and second quarters will finally capitulate and sell their holdings. The final downward leg will be the most brutal. The Magnificent Seven stocks will reach their nadirs in late September. Apple will be down 48% from its peak, Microsoft down 46%, Nvidia down 62%, Amazon down 51%, Alphabet down 43%, Meta down 47%, and Tesla down 71%. The aggregate market capitalization destruction from these 7 companies will amount to $7.1 trillion. The S&P 500 will bottom out at 3,700. Quarter 4 of 2026, October through December. The market bottom will form. Volatility will remain elevated, but the forced selling will eventually exhaust itself. All individuals who were inclined to panic will have already done so. Value investors will begin to engage in buying activities. Warren Buffett, holding $325 billion in cash, will commence deploying capital into high-quality companies at sensible valuations. The recovery process will initiate, albeit slowly and with considerable pain. By December 2026, the S&P 500 will have rebounded to 4,200, still 39% below its 2025 peak. The Magnificent Seven will have lost their aura of invincibility. They will represent 24% of the index, a decline from their previous 32% weighting. This unwinding of concentration will occur not solely because these stocks depreciated more significantly, although they did, but rather due to a rotation of capital into other segments of the market. A full recovery to the 2025 peak will not materialize until late 2028 or 2029. However, the Magnificent Seven stocks will never fully regain their prior valuation multiples. They will trade at price-to-earnings ratios between 18 and 24, a stark contrast to their previous range of 40 to 70. Investors will have learned a harsh lesson. Concentration breeds risk, not security. Now, allow me to illuminate precisely who will face ruin and who will emerge intact from this wealth transfer. Understanding this distinction is paramount to determining whether one will be a victim or a survivor. The vanquished will be those who subscribe to the notion that passive investing eradicated risk. Consider the retail investor who allocated their entire $600,000 retirement account into an S&P 500 index fund, or the pension fund manager who held 32% of their $48 billion fund in the Magnificent Seven, mirroring the index weight, only to watch the fund depreciate by $12 billion, rendering the pension significantly underfunded and necessitating benefit reductions for workers who believed their pensions were secure. Consider the 41K holder who automatically invested every paycheck into a 2035 target date fund that was 75% allocated to the S&P 500. They will witness decades of savings evaporate. This individual, aged 45, with 20 years until retirement, believed time was on their side. However, time offers no solace when one is concentrated in overvalued assets that subsequently collapse. The vanquished are those who place their trust in financial media pronouncements like, "You can't go wrong buying the best companies." They are also those who believe the adage, "This time is different," when informed that valuations no longer mattered. The vanquished are those who conflated popularity with intrinsic value. The survivors, conversely, will be those who comprehended concentration risk and proactively diversified across various asset classes. The survivor might have maintained a portfolio allocation of 40% stocks, 30% bonds, 20% cash, and 10% gold. When stocks plummeted by 46%, their total portfolio would have experienced a mere 18% decline. The survivor possesses the capacity to rebalance their portfolio, acquiring stocks at depressed levels with their available cash reserves. The survivors are also those who recognize the extreme valuations prevailing in late 2025 and strategically harvested their profits. Such a survivor would have divested their concentrated position in Nvidia when it reached $790 per share with a price-to-earnings ratio of 58. Understanding that semiconductor companies do not warrant such lofty multiples. While they may have foregone the final 5% of the rally, they would have successfully evaded the 62% subsequent collapse. The survivors are those who understood that passive investing during market bubbles inevitably leads to holding overvalued assets and disregarded the pervasive "just buy and hold forever" narrative. These individuals transition to active management or individual stock selection, consciously avoiding overvalued megacap stocks. The survivors are those who diligently analyzed the data, recognized the recurring historical pattern, and took decisive action prior to the market's downturn, not in its aftermath. The survivor is likely reading this exposition in early 2026, comprehending that the ensuing 6 to 12 months will critically shape their financial destiny. The collapse of the Magnificent Seven is not a remote possibility. It is a mathematical inevitability that is presently unfolding. The level of concentration is unprecedented. The valuations are demonstrably unsustainable. The growth trajectory is decelerating. The passive capital flows that inflated these stocks are poised to reverse, deflating them with equal ferocity. 7 companies, representing $14.2 trillion in market value, trading at an average price-to-earnings ratio of 42, would require 25% annual growth to justify their current valuations. However, they are currently achieving only 12% growth, and this rate is decelerating. When market realities inevitably confront inflated expectations, $7 trillion in market capitalization will evaporate. When 32% of the market's aggregate value disappears, the remaining 68% will inevitably be dragged down. The timeline is clear. The first quarter of 2026 will mark the undeniable onset of growth deceleration. The second quarter of 2026 will witness analyst capitulation and the commencement of forced selling. The third quarter of 2026 will see the cascade reach its apex, with the market finding its bottom. The fourth quarter of 2026 will initiate a slow recovery. You have a window of 3 to 6 months to reduce your exposure to the Magnificent 7 companies. It is advisable to reduce your allocation to passive S&P 500 index funds, increase your holdings in cash and bonds, and strategically prepare to invest at the market's nadir. The crash is imminent, guaranteed by mathematical certainty, necessitated by extreme concentration, and demanded by unsustainable valuations. The sole uncertainty lies in whether you will be adequately prepared when it strikes, or whether you will become another casualty of the most significant concentration of risk in financial history. This phenomenon is not merely financial compression. It is a historical pattern demonstrating that exorbitant valuations cannot be sustained when economic growth decelerates. Understanding this pattern is the fundamental prerequisite for survival. What lies ahead?